Good day and welcome to my next Warren Markets review. This is for the 13th of May. I'm recording this late night. You'll probably get this on the 14th of May in your laptops. Well, today was a recovery day from the market after four consecutive days of losses. And Mr. Modi's austerity drive, which had driven the correction of the last few days, today there was a relief rally. The Nifty index was up about 0.14%, the mid cap about 70 basis points, the small cap about 30 basis points, and the micro cap about 70 basis points. So clearly, again, the pattern of the previous few days, except for yesterday and day 4, where the broader market is done better than the large cap portion of the market, indicates that retail buying has again stepped in and bought today. The advanced decline ratio of about 1,734 stocks up to 1,200 stocks only down clearly indicates, though not as strong as a 3:1 or 4:1, it was a 1.4:1, right? And FIS, who yesterday we saw that the selling was less, today it's back again to about 4,700 crores of selling, and DIs on such a day have stepped up their buying to 5,800 crores. But the net difference is only about 1,100 crores. So clearly, retail buying also played its part in helping the market recover today. What is the reason for the recovery? Because there was not much change in the geopolitical situation. Iran's proposal not being acceptable to Mr. Trump. There was no change in the Hormuz Strait ships going through, though there is news that a few Indian ships have passed through. Oil prices continue to remain at $106, $107. The rupee continued to slightly weaken. It's now touched 95.70. And the forward premium for the rupee has now expanded to 385 basis points, which means that 1 year forward is now dangerously close to 100. It's at 99.80, right? So all of this means that the FIS selling was on track, because for them, a weakening currency, high oil, all of that continue to be negative territory. But retailers stepped in to do value buying today, because I think the 2-3 days of correction, again, retail and DIS to some extent are seeing that any correction is a chance to buy, because there is liquidity in their hands and they are keen not to lose the opportunity, right? So from that point of view, the sectors which did well today were the metals. Again, the geopolitical is a positive for metals. Defense, again, retail buying in defense. Consumer durables were 1.7%. So metals was up 3%. Defense was about 2%, and consumer durables about 1%, and oil and gas naturally, because of the strong oil prices and the fact that government gave a royalty relief to the oil producing companies, meant that that was also a positive sector today. And a little bit I saw the infra and manufacturing indices were also up 1%. What did do too well today? It's IT. Well, IT has not been doing well for quite some time in the last few days, and year to date it's down 25%. Now, what is the sudden reason for this? I forgot to discuss this yesterday, so I'll just touch upon it today. OpenAI launched a $4 billion company which is going to put engineers inside user companies' offices to manage their AI transition processes. So this is the work of software companies. So they are now coming into direct competition to the software, and obviously with the use of AI, doing with far less cost and far less. So this has thrown up a new challenge to the software industry worldwide and to India. And hence, despite the rupee weakening, which is normally a positive sign for FIIs at least to buy IT continues to be under pressure. Today's fall was not that great, only 1.2%, but it's still a sector under pressure. And with 25% correction, it's moved definitely into a value zone, but it could remain as a value zone for quite some time, because next threat from AI, Claude or somebody else coming up with a new project, again will mean that there will be pressure. So like I mentioned before, IT can be a part of the value part of your portfolio. It's still quite far from being in a growth part of your portfolio. The FIS have not only been selling in the cash market, they have been building up shorts on the Nifty futures and buying protection of the puts for quite some time, and today also they did that. And so from that point of view, the long short ratio for FIIs is showing to be 22.78 from yesterday's 24.76. So it's gone more short today. And the put call ratio has also gone up to 0.93. So they're buying a lot more puts from 0.5 yesterday. So clearly a negative bias from the FIS continues, and retail stepped in to do cost averaging of their portfolio. Now the GIFT Nifty is showing a positive sign today, about 100 points up. But like I said, it's still on a very weak wicket because of the fact that the war shows no sign of ending. Now, I've spent about 5 minutes talking about the market and this. I want to spend another 3 to 4 minutes today talking about the Modinomics, which is the Modi's austerity drive. I got a request from many people saying, please speak about that and its implications. And so I thought I'll spend a few minutes today. It's opportune because it's also affecting the markets in a big way. And given today's recovery, is that something that's already done and dusted and forgotten? Let's analyze this, right? So Modi's austerity speech, which he gave in Secunderabad 2 days ago, was focused around three things, right? What was this? It was around gold, reducing gold usage, reducing travel, direct implication on oil, and reducing the use of imported fertilizers, direct impact on the imported gas. Now, overlying all of this, he also made the point about foreign travel, so which means that in addition to this, there's a currency overlay on that, right? Now, all of this is hurting India, and that's why today Mr. Modi's statements is in the form of a signal that is going from a seeking voluntary compliance of an austerity to bring down the impact on the economy. So the signal first was to tell ordinary people, because I think without the retail petrol prices going up, people have not yet felt the pain. LPG, there's been some shortages, some waiting period, but still the prices for domestic LPG, I don't think have gone up. So Indian population has been insulated, and the government, for whatever reason, maybe because of the elections, had not come out with a white paper and made this clear. But today they have come to the voluntary, and the market reacted badly for the last 2 days because they thought this voluntary is now going to become into mandatory regulatory action. And today it followed through with the gold import duty hike. Now, what is the purpose of all this and what is the implications? So first thing is that we had an oil basket at around $65 to $70, take it at $70 before the war started. And on that basis, India's current account deficit, what is current account deficit? It is the trade deficit plus any short-term flows in and out. That's the current account. Capital account is FDI money coming in. That's called capital account, or NRI remittances. Yes. Current account is a deficit, which means we don't get enough money in, but a lot of money is going out, dollars. So current account is only 0.8% of the GDP FY26, the year that finished. Because of the sharp increase in oil prices to 110, that's straight away a $35 increase in our costs. So the current account deficit is expected to go, various people, economists again vary estimate, but varies between 1.8 to 2.4. So at 2.4, you're talking about 3 times the current account deficit as a percentage of GDP. So this fear has led to a run on the rupee. So the rupee, as you know, has been the worst performing currency in Asia against the dollar. And today it touched 95.94 at one point, but it recovered a little bit because of RBI selling to 95.70. And as I already mentioned, the 1 year forward is almost close to touching 100. So what happens is that the oil price increase in rupee terms is even worse than the $35 because the rupee has gone even worse. So it's a double impact on the economy and the government's finances and fiscal. So the government is obviously trying to avoid that. So far, they have not passed on the heat to you. They have absorbed the heat by taking off 10% from the petrol excise duty and from the diesel. So diesel is down to 0 and petrol is down to 3%, right? So the key is that oil marketing companies are picking up the burden today. And do you know how much that is? It is 1,500 to 1,600 crores per day. So if you take 20 working days in a month, that's 30,000 crores a month. and that 30,000 crores a month for a full year is almost 4 lakh crore rupees, 4 trillion. That's the losses the oil marketing companies are currently. If this oil price continues for a long period of time, that's what they are clocking in month on month. The excise duty cut by the government has meant a loss to the government of 14,000 crore rupees a month. So add 30 there and 14. The net loss to government plus PSUs is 44,000 crore rupees a month, right? This is not sustainable, and so a petrol price hike is inevitable. Take it from me. Now, the gold, why is that a problem? The gold is a problem because gold tonnage is about 750 to 800 tons. The jewelry demand that Mr. Modi spoke about, that's actually been coming down on its own because the price of gold has gone so much that people are buying automatically lesser. So from 500 to 600 tons of jewelry purchases earlier, we are down to about 430 tons last year. But the price of gold has gone up, so the actual rupee impact has not come down, and we are forced to pay in dollars. So gold is also contributing to the weakening of the rupee, which is hurting the amount that we pay for the oil. So that's why gold is an important thing. The third is because the currency's impact is there, foreign travel means you spend dollars. So again, and Pradhan Mantri Modi's thing was, look, voluntarily, please try and bring down this through either work from home, trying to use public transport, trying to reduce foreign travel, trying to buy less jewelry. So he started off with a voluntary thing in the hope that if there's a success in voluntary, to that extent, they can either postpone the oil price hike for the consumer, or they can at least minimize it whenever they bring it. Now, so they implemented today the first part of the voluntary to a mandatory by bringing back the gold import duties. Now, by this, what is happening? So if you take the current account deficit, I mentioned imports, 22% of it is from oil. So it's the single largest import bill at about $175 billion is what we import oil, right? Now, second mortgage is gold, but it's a fraction of what is spent on oil. So last time around, the government's effort at putting this tax excess on the tax from 6% to 15% is in the hope that it would bring down consumption of gold and thereby ease the pressure on the currency to import so much. Right? That's the main purpose, because the excise duty itself on gold is 9% more is not going to lead to much revenues to the government, because the previous time they did this, I think it was way back in 2013, I think they hiked it, the gold purchases collapsed from 1,000 tons to about 10% of what it was before. So people really took it to heart. And the second is smuggling started in a big way. So a lot of the purchase of gold goes up through the Hawala route. So this gold import duty is again a signaling. It hopes to bring down the demand, but it's not really going to help the government not to reduce petrol prices. Initially, I thought that maybe the income from 9% on the gold imports, the money would come and would help them delay. But when I look at the numbers are hardly 10% of the impact of the price of oil can be covered by the gold. So then what is the plan of action of the government? Well, they want you to try and conserve the currency. So the next step of actions could be around putting a tax on foreign travel, could be around bringing down the LRS limits, which is right now $250,000 per person, $1 million for family. They could bring back the curbs on it, whatever, I don't know. But all of those are also just signaling measures. Oil price hike at the retail is inevitable because 44,000 crores is unsustainable. Now, the government has about 60 odd days of stock. There's no supply issue, except that in the case of LPG, right, because of the damage to Qatar's gas refinery, there's a combination of a supply plus this, but the government has made enough arrangements to get that. So my sense here is that the government is steadying up to clear the road, to give you the sense to the people that this situation is quite severe. They may not hike the petrol prices immediately. According to me, till the month of June, they should be able to sustain July. So they are hoping first to have a voluntary support from the public of India. But secondly, they're hoping that the war will end in 8 to 10 weeks max, which is what their plan is, I think. But if the war lasts beyond 8 to 10 weeks, they'll have no choice but come June or July to actually do a petrol price hike. And I anticipate that could be anywhere between 5 to 10 rupees per liter in terms of that. Right? So that's the seriousness and the severity of the situation. And one another thing which has not been contemplated but come into context is the next biggest part of imports is consumer electronics goods, consumer durable goods, imports component of those goods and imported goods itself. So government could bring in a kind of excise duty or a ban on those things, which will have quite a severe impact. So today I saw the consumer durable index actually shot up by 1.75%. I don't know how sustainable that is, because if such a move becomes public, the consumer durable space will also get hit. So at this stage, I just want to give you a summary. It's been a very long message today, but I just want to give you a summary of what this latest Modinomics, as I wanted to call it, means, the implications of it. And like I said, ultimately, the oil price, if the war lasts for longer than 8 to 10 weeks, a petrol price and a diesel price hike is inevitable, because keep the math in mind, 44,000 crores per month is the loss incurred. Multiplied by 12, it's 5 lakh crore rupees, right? So thank you. I hope you enjoyed listening. This is a very long chat by me, but I thought the need of the hour was to explain it because it has direct implications on the market for us in terms of any such announcement by the government would react to further reaction from the markets. Thank you and good night.